Okay, welcome to the accounting and finance coaching session. And today we want to look at the internal rate of return. Now, we have looked at the payback period as a technique of investment appraisal. We have looked at the accounting rate of return, which we say the payback period and the accounting rate of return are non-discount factor methods. And then we've also looked at the net present value, which we said is the best investment appraisal technique. Now, the other method that we want to look at today is the internal rate of return. As I told you before, my method of teaching is using the simplest examples for starters. Much later, we're going to look at professional examination questions that are complex, that will bring in inflation, taxation, and working capital, scrap value, and what have you. And we'll see a mix of all of them in perhaps a couple of professional questions. But the important thing is once you've learned the building blocks of whatever method that we're teaching, it's normally easy peasy. Even if they get complex, all you need to do is just to bring them in. You have the concept of what is a cash flow, of what is a cash inflow, of what is a cash outflow, of what is the net cash flows. So once you know all of this, you've learned how to discount, which is a 1 all over 1 plus R raised to power n. I told you the n is for the year. In year 0, it's raised to power 0. In year 1, it's raised to power 1. In year 2, it's raised to power 2. Year 3, it's raised to power 3, and so on and so forth. So we've learned all of that. Now, what we want to look at is the internal rate of return, the IRR. That is what we want to look at today. Good. And to do this, it is that NPV, it is that rate that gives you the NPV equal to 0. This may not make sense, but as we do an illustration, it will make a lot of sense to you. But basically, the technique of calculating the IRR is similar to that of the net present value. Usually in an examination, we are given the cost of capital. We have the cost of capital. Now, if you are given the cost of capital, you are expected to calculate the NPV for that cost of capital. It could give you a positive NPV or a negative NPV. It could give you any of this. Now, if you have, usually in examination questions, you get to have a positive NPV. But because we are not learning for examination purpose alone, we are learning how to use our knowledge to work in our various places, to teach, and also to make ourselves more productive. That is why we learn. We don't learn to pass examinations. No, we learn perhaps to pass examinations so we can be certified and to use that knowledge to better ourselves, our families, and our society. That is why we work. So we can increase our productivity, so we can be more efficient at what we do. All right. So now, if you have a cost of capital given to you in a question, the first thing for you to do is to calculate it. If you have a positive NPV, let's say at 5% cost of capital, it means you have to raise up this percentage by yourself. So perhaps maybe you could do 12. You could say 5, or maybe you could say 5 to 9. So if you have the first one, which is given to you, or in some cases you don't have any cost of capital given to you. Now where you don't have that, it means you have to have 2 NPV calculations. When you have 2 NPV calculations and you have one positive and the other giving you a negative, then it means you can now do a step which we call interpolation. You can now do what we call what? An interpolation. So the interpolation is basically what we use to get the IRR. So the step 1 is to use the NPV, the cost of capital given to you, to calculate the NPV. And of course, you remember that in our NPV, we say the calculation is to get your year from year 0, year 1, year 2, year 3, year 4, year 5, as the case may be. And then next you have the cash flows. You put the cash flows in the initial outlay, which is now, that is year 0. We make that money, that's the money that is going out. That is the money for the investment. So we put it in year 0. And then for year 1, perhaps we'll have an inflow. You put all the net cash flows that are coming in year 1, 2, 3, 4, 5. And then the next thing is for us to do our discount factor. The discount factor, if it is 1% or 2% or 3%, depending on what we have, we now calculate using our compounding formula, which is 1 all over 1 plus r raised to power n, which I said we will continue to compound at year 0. We always have 1 because every number raised to power 0 is equal to 1. And for year 2, we say any number raised to power 1 is equal to that number. Don't forget. So now, after compounding, we say the first column is for years, the second column is for our cash flows, the third one is for the discount factor, and the third one is for the present value. So you have the present value, which is gotten by the discount factor multiplied by the cash flows, which will give us the present value. And when you sum up your present value, you now have what we call a net present value. Now, when the present value is positive, we say you accept the project. When it is negative, we say you reject because it will not maximize shareholders' wealth, because it will not be profitable for you to invest in that project. Good. Now, the IRR follows that step. It follows that process. For step 1, I said you calculate the NPV, which usually will give you a positive NPV. If you have the cost of capital 9%, for instance, and you have the first calculation and the NPV gives you a positive, for you to get a negative, you are going to do it by trial by error. You keep trying, but because you don't have time to try so many times, you have to use a higher cost of capital. So if in the exam you have 9% and you have a positive NPV, you could now increase your cost of capital to, let's say, 16% and do another set of NPV calculations. Now, this is going to give you a positive NPV calculation and a negative NPV calculations, usually. Sometimes you have a positive NPV and your second trial gives you another positive NPV. Sometimes you have a negative NPV and your second trial gives you a negative NPV. Now, where that happens, if you interpolate, you are not wrong in the examination. But in real life, what it means is that your result is not a reliable result. You have a less reliable result. For best interpolation, it is good to have one NPV calculations giving you a positive and the second one giving you a negative. Now, what is this interpolation I'm talking about? I've been saying interpolation. There's a formula for interpolation, and I want you to look at it and understand. Now, interpolation. We'll say the IRR is equal to NPV, or let's do it this way. Let's call it the A%, okay, plus NPVA all over NPV A minus NPV B. Okay? And then here we say minus, we'll say B minus A. So this B% and A%. This is how we interpolate. Now look at this. Let me explain what this means. A% is the first cost of capital, the percentage that is used. That is the first cost of capital. As I was explaining that you have the first one 9% and the second one I said 16%. Now, if your first trial is this 9%, it means this is a percentage in your interpolation. It means your number will be 9%. Good. Now, the second one, 16%, that will be, so this is A%, and now this will be B%. So, if you know this to be A% and B to be this, then that is that. Now, let's get to MPVA. What is MPVA? The MPVA is the value that you have calculated in your first trial, which gave you the positive MPV. That is MPVA. In other words, the MPV value you got from using this cost of capital is what we call the MPVA. It could be 20, it could be 40, it could be 1, it could be 2, whatever it is, whatever that value is, that is your net present value. Value, not percentage. Value. The value is what we call MPVA. And MPVB is the one that is negative. Is the MPV of your second trial using the second cost of capital that gave you a negative MPV. That is, that value is what we call the MPVB. And following the rules of mathematics, don't forget that when we say MPV A minus a negative minus NPVB, you know that this minus will give us a plus. Don't forget that. Now let's look at a question to illustrate the internal rate of return. And I'll tell you what it is. Basically, it is the average annual return. Okay? It is similar to, but this time around it's just the average. It's basically the IRR is basically the one that shows that your net present value is 0. So it takes the average between the negative MPV and the positive MPV. You have the positive, you have the negative. So the one that takes the average is this middle. You have from this point all positive, and you have from this point all negative. So this point here is the middle, and you know the middle is like the average. So that is the average. So this is where the MPV is equal to 0. Okay. Let's look at an example, another simple example. A business requires expected rate of return of 12% on its investment. A business requires minimum. So expected equals 12%. Good. A proposed capital investment has the following expected cash flows. So in this case, in this example, we are given the cash flows. This makes it easier for us, so that it's just for illustration. As I said before, we begin our examples, we begin our teaching with the simplest illustrations. Much later, we can now compound them more. We can make them more complicated by the time you have understood. So we're going to give you, this question gives us the calculation. So we have the first one, which is giving us year 0, 1, 2, 3, and 4. Now it gives us cash flow. The cash flows in Naira, don't forget. The first one is 80,000. That is year 0. That is now. Year now. There's no year called year 0. But we, for investment appraisal, when we say year 0, we mean now, when the initial outlay is to be expended. So we have 2036, 20,000. We have 36,000. We have 30 and 17. 30,000 and 17,000. Good. Now the DCF, so we'll say the discount factor is at 10%. So this is the first one. This is the first trial using 10%. And this is going to give us 1 already. We know that. Why is it 1? Because we say 1 all over 1 plus r raised to power 0. Your n is 0. And anything raised to power 0 is equal to 1. And 1 divided by 1 is 1. So year 1, year 0 is 1. The next one should be 0.909. 0.909. This is 0.826. 10% is really easy to, if you do this a lot of time, 10% is easy for you to remember. You could just remember all. So 751, 0.751, 51, and then the next one is 0.683. 0.683. Good. This is using 10%. Now the next trial, I told you that for IRR, we use the first discount factor. If we have a positive MPV, then we take it further, and then we raise the cost of capital higher so we can get a negative. So let's look at the PV. The PV, that's the present value, at this is 80,000. This is giving us 18,180. 18,180. The next one is giving us 29,736. 29,736. This one is giving us 22,530. 22,530. And the fourth one is giving us 11,611. 11,611. Good. Now the next discount factor we're going to try is moving it up to 15%. And that will give us the DCF of 15%. Now, at 15%, of course, we know that year 1 is also going to give us 1. Just like this, the same thing applies. And then the next one is going to give us 0.870. 0.870. This next one will give us 0.756. 0.756. The next one will give us 0.658. 0.658. And then 0.572. 0.572. Good. If you are lost here, I want you to please find yourself very quickly. Don't forget that what we're doing 1 all over 1 plus r raised to power n, where n is the year, where r is the cost of capital. Okay? So if you do for 15%, 15% is simply saying 1 all over 1 plus 0.15 raised to power 0 or 1 or 2 or 3, as the case may be. This is what we're doing. So I've demonstrated that before. I don't need to do that anymore. I'm sure you're following, and I'm sure you can do it on your own. If you have questions, don't forget to please send me a message so I can reply you immediately. If you have not subscribed to this channel, please, I want to urge you to do so. It's the accounting and finance coaching session. Do that very quickly. Invite your friends who are accountants. or who are aspiring accountants. If you're preparing for a professional examination question, I urge you to subscribe to this channel and share it with your classmates. If you're already a professional accountant, I also urge you to subscribe to this channel so you can stay up to date with accounting practices, accounting terms, accounting concepts, accounting standards, because we basically teach financial accounting, we teach strategic financial management, we also teach taxation and finance generally. Okay, so we're looking at the internal rate of return. Now, the discount factor at 15 will give us, next we'll get the present value. So that is the PV. The PV for year one is always the same thing. So in this case, we're going to have the same 80,000. Next, we're going to have 17,400. That is 18,180 multiplied by this. What will that give us? Remember, we are using a question that has been solved for us. And this question, I said, is the essence of this question is to illustrate and understand the IRR. So we have 17,400. 17,400. Next, we have 27,216. 27,216. Next, we have 19,740. 19,740. And lastly, we have 9,724. 9,724. Good. Now, having gotten all of this, when you total this and you total this, you have your NPV. So the NPV, that's the net present value, is the summation of your present value. So when you add all of this, and I say the best way is to add up. Add up. So you can get your NPV. So this has been done for us so that we don't waste time. If you sum this up, you sum this, the positive present value to give us the net, we have 2.057. 2.057. And this is a positive. This is positive. This is our positive NPV. Okay? So sum it up and see. Just to confirm, you see that you have a positive NPV. And I told you that the interpolation needs a positive NPV and a negative NPV before we can successfully do our interpolation. And that is the most reliable. That where you have a negative NPV and another negative NPV, when you interpolate, your result is less, very, very less reliable. And then for the other one, we have a negative, which is 5,920. 5,920. And this is a negative NPV. So when we have this, once you see a figure in bracket, as we call it, it means it is negative. So there's no need to put a plus here. In accounting, usually once you see it in bracket, it signifies that it is a negative figure. So this is a negative NPV, and this is a positive NPV. Now let's bring out the formula so we can, I don't know if you can see down below, but what we have, let's extract them. Let's extract. A formula, just to remind you that the IRR is A%. This A% stands for the first cost of capital in the experiment. I told you that for IRR, we have to do at least 2 experiments. That's 2 calculation of the NPV. And it's experimental because you are supposed to get a positive NPV and a negative NPV so you can interpolate. Now, for the example we are looking at, we have already gotten a negative and a positive NPV. So the first cost of capital is what we call the A%. And if you recall, the percentage we applied first is 10%. Good. Now, this is NPVA. This NPVA stands for the value that we got from using the 10%. So the cost of capital that we use in the first experiment, that's the calculation of the NPV, gave us a value which is a positive NPV, and that is what we call the NPVA. So A% gave us NPVA, B% gave us NPVB. Good. Now, NPVA divided by NPVA, this is also the value of the same NPVA that we have up there. The numerator and the denominator, of course. Then this minus NPVB. But don't forget that NPVB is negative. And so, if we bring this, what is our NPVB? We have 5920. And NPVA is 2057. Now, let's lock this into the formula. Then you have your B% minus A%. Once you do this, you have done what we call interpolation. Now, what is A%? A% is 10. I will say 10% plus. What is NPVA? NPVA is 2057. We'll say 2057. All over what? All over 2057. 2057 minus 5920. 5920. We put this in a bracket. I like to put this in a bracket. And then here we say B%. B% is what? B% is the second cost of capital we experimented with, which we call 15%. Is the percentage we use to get the negative NPV. So we say 15% minus 10%. Good. Now, if you come down here, you have 10 plus, you solve all of this. This will give you 2057 all over 2057 plus. You know that minus will give you a plus. Negative gives you a positive. So we now have 5920. Okay? And then here we have 5%. Coming down here, this is equal to what? 10 plus, let's solve that. Let me grab my calculator. I just hope to get a good calculator soon so I don't have to use my phone. But you know, well, everybody uses a phone this day for calculation. I don't know why. But of course, you know, this won't be allowed in the examination. So get a good calculator, get a good scientific calculator. And in real life, use your Excel. It is more reliable. Okay, so we'll say 2057 plus 5920. That will give us 2057 divided by 7977. 7977. And then this is multiplied by 5, isn't it? So if we say 2057 divided by 7977 multiplied by 5, we have 1.3. This gives us 1.3. And then we have 10 plus 1.3, which will give us 11, which will give us 11.3%. So we have 11.3. 11.3%. This is what we got as our IRR. So IRR, this is the expected, and this is the calculated. So the company expects to get a 12% return using the internal rate of return. This is what they expect to get. But from their calculation, based on the analysis of this project, they have 11.3%, which is lower than 12%. And once your expected return is higher than your calculated, you reject it. I mean, you are expecting 12%, but you only got 11%. So what do? You cannot accept, you have to reject, which is what? We reject. We reject. So that is the IRR. So let's go over the steps very quickly. If you have not subscribed to this channel, I want to urge you to please do so. Is accounting, just look for Accounting and Finance Coach on YouTube, and please subscribe to the channel. So, and please share with your friends who are either accountants. If they are professional accountants, they perhaps know this already, but they also need to stay up to date and also to practice so their knowledge does not go stale. If they are also studying to become professional accountants, to be chartered, they need this. If you're in school, you're studying accounting, you can also follow this channel. Share with your friends who are studying accounting or who want to move from other fields into accounting. Even if you're not studying accounting, it is very good for you to know how to evaluate projects, how to use investment appraisal methods, especially engineers. You have to consider which project is viable. Sometimes you have project A, B, C, D, and you have to make a choice to select one. Imagine that we use the IRR to analyze 10 projects. How? Which one will you take? You take the one with the highest IRR because it means that is the one that is most viable. The same with your MPV, the highest MPV. Sometimes you have two projects and they are mutually exclusive. Mutually exclusive means if you take one, you cannot take the other. If you accept one, you cannot accept the other. And why? Why can't you accept both? You cannot because there are always limiting factors. You don't have enough money, so you don't have enough capital to invest in both projects. So if they are mutually exclusive, you have to do a calculation for both of them. If you look at the MPV of the first and of the second, you compare which one is higher. Remember that if they are all positive, they are all good projects. Once the MPV is positive, it is good. But if they are mutually exclusive, you can only take one. You cannot take all of them. You cannot say because positive MPV means accept, accept, accept. You have to accept 100 projects because they are all having a positive MPV. No, you cannot do that. You don't have the funds to take all of them. So you have to look at the one with the highest net present value and accept it. And also for the IRR, you do the same thing. But in this example, the expected IRR, that's the internal rate of return. The expected factor is 12%, but the calculated is giving us 11.3, which is short of about 7, that's 0.7 to get to 12. And so because it is lower than what is expected, you reject. Assuming that we calculated 14%, which is higher than this, then we accept. Assuming we calculated 12, exactly 12, we also accept. It means at that point, well, it's your break-even. You accept it. It's also good because you are expecting 12 and you got 12. If you have anything higher, the more, the merrier. So this is where we're going to stop. We're also going to delve into taxation, but please don't forget to share with your friends. Thank you.